Are you exhausted from the never-ending cycle of living paycheck to paycheck? Is your hard-earned money just sitting idly in a bank account not working for you? Or perhaps you're feeling anxious about whether you'll have enough to enjoy a comfortable retirement? It's time to break free from these financial stressors and take control of your financial future. Join us in our latest video, Where to Invest Your Money, where we unveil powerful investment strategies in stocks, REITs, Forex, and commodities that have the potential to transform your financial landscape and pave the way for a future of financial freedom and prosperity. Investing in the stock market is fundamentally about acquiring ownership in various companies by purchasing their shares. When you invest in a company's stock, you're buying a piece of the company, and your investment's value is intrinsically tied to the company's performance. Successful companies can provide returns to investors through capital appreciation, where the value of the stock increases over time, and potentially through dividends, which are portions of the company's profits shared with investors. However, investing in stocks is not without risks. Companies may underperform, failing to meet their objectives or running into financial difficulties, which can lead to a decrease in stock value. In extreme cases, if a company goes bankrupt, shareholders might lose their entire investment. Understanding and assessing these risks, in alignment with one's risk tolerance, is a crucial aspect of making informed and resilient investment decisions. In terms of executing stock investments, various online brokerage platforms facilitate the buying and selling of shares. Platforms like E-Trade, Charles Schwab, and Fidelity offer extensive access to a wide range of stocks and other investment vehicles. There are also more recent entrants like Robinhood and Webull, which offer user-friendly interfaces and features appealing to newer investors. Additionally, robo-advisors such as Betterment and Wealthfront offer automated algorithm-driven financial planning services with little to no human supervision. They create and manage a diversified portfolio for investors based on their risk tolerance. Stock investments can also be categorized based on their return mechanisms. Some stocks pay dividends, which are regular payments made to shareholders from the company's earnings. Dividend stocks often represent established companies with steady cash flows and tend to be less volatile. On the other hand, growth stocks primarily offer returns through capital appreciation. The value of these stocks is expected to grow at an above-average rate compared to other companies in the market, but they might not pay dividends. When contemplating an investment in stocks and equities, several key considerations should guide your strategy to foster informed and resilient investment decisions. Firstly, diligent research is paramount. Endeavor to acquire a comprehensive understanding of the companies or funds you aim to invest in. Scrutinize aspects such as their historical performance, the competence of their management teams, and the viability of their growth prospects. This foundational knowledge is instrumental in assessing the potential risks and rewards of the investment. Diversification is another crucial aspect of a robust investment strategy. Avoid concentrating your investment in a single asset or sector. Instead, aim to distribute your investments across a diverse array of sectors and industries. This strategy can help in mitigating risks, as the performance of various investments will likely respond differently to market changes and economic cycles, enhancing the resilience of your investment portfolio. Lastly, adopt a long-term perspective when investing in stocks and equities. The stock market is inherently subject to fluctuations and volatility. However, maintaining a long-term outlook can facilitate a more steady and patient investment approach, enabling you to navigate through market volatilities and uncertainties with a focus on long-term growth and objectives. By incorporating these considerations, research, diversification, and a long-term perspective, you can cultivate a thoughtful and balanced investment strategy in the realm of stocks and equities. Consulting with financial advisors or investment professionals can also be beneficial in making informed investment decisions. Now that we've mastered this, let's move on to mutual funds and ETFs. Mutual funds and exchange-traded funds, ETFs, are potent vehicles for investors aiming to build a diversified portfolio. Mutual funds amalgamate resources from multiple investors to purchase a varied collection of stocks, bonds, or other securities, managed meticulously by professional fund managers. This collective investment scheme not only offers access to a broad spectrum of assets, but also the expertise of seasoned fund managers who oversee the portfolio, making strategic investment decisions. The benefits of mutual funds are manifold. They inherently promote diversification by spreading investments across a multitude of securities, which can mitigate risks. Moreover, the professional management of mutual funds alleviates investors from the intricacies of continuous portfolio monitoring and decision-making. Investment in mutual funds can be facilitated through various avenues, such as banks and other financial institutions, as well as online brokerages like Vanguard, Fidelity, and Charles Schwab, each offering a diverse array of mutual fund options. ETFs, on the other hand, bear resemblance to mutual funds in diversification, but are traded on stock exchanges akin to individual stocks. They offer investors the flexibility to buy and sell holdings promptly during market hours, ensuring liquidity and adaptability. ETFs are also generally associated with lower expense ratios, making them a cost-effective investment option. In essence, mutual funds and ETFs embody essential tools for investors seeking diversified and strategically managed investment avenues. Their structured approach, coupled with professional management and strategic asset allocation, makes them instrumental in navigating the investment landscape, especially in the face of challenges like inflation. Up next, we have something even more exciting to explore: real estate investment trusts, REITs. REITs are companies that own, operate, or finance real estate that produces income. They offer a way for individual investors to earn a share of the income produced through commercial real estate ownership without actually having to buy, manage, or finance any properties themselves. Investing in real estate investment trusts, REITs, comes with several notable benefits. One significant advantage is liquidity, as REITs are traded on major stock exchanges, allowing investors to buy and sell shares with ease, much like stocks. This trading flexibility is a considerable attraction for investors looking for real estate exposure without the typical complexities of direct property investment. Another appealing aspect of REITs is their dividend potential. REITs are renowned for offering attractive dividends, primarily because they are mandated to distribute at least 90% of their taxable income to shareholders. This requirement often results in higher dividend yields, making REITs a favored option for income-seeking investors. For those interested in investing in REITs, various avenues are available. Shares of publicly traded REITs can be purchased through brokers on major stock exchanges, providing easy access to the real estate market. Additionally, there are REIT mutual funds and ETFs, exchange-traded funds, available. These funds aggregate money from multiple investors to buy a diversified portfolio of REITs, further enhancing diversification and reducing individual investment risk. While REITs offer a convenient and liquid way to invest in real estate markets, they're not the only avenue available. For investors who prefer a more hands-on approach and direct control over their investments, direct investment in real estate properties is a viable alternative. This option allows investors to purchase physical properties, whether residential or commercial, and manage them for rental income and potential appreciation in property value. Investing directly in real estate properties comes with its unique set of benefits, primarily revolving around control and inflation hedging. When you invest directly, you wield substantial control over various aspects of your investment. You have the autonomy to select the specific property to invest in, choose your tenants, and manage the property according to your strategies and expectations. This hands-on approach allows for a tailored investment experience, enabling you to make decisions that align closely with your investment goals and risk tolerance. Another compelling benefit of direct real estate investment is its role as a hedge against inflation. Real estate properties often stand resilient against inflationary pressures. As inflation escalates, it often drives up rents and property values concurrently, allowing real estate investments to maintain their real value and purchasing power. For those considering diving into direct real estate investment, several strategies and platforms can guide your initial steps. A practical approach is to begin with local real estate markets where you possess a more profound knowledge and understanding, facilitating more informed investment decisions. Online real estate platforms such as Zillow and Realtor.com are invaluable resources, offering a wealth of information to help identify and analyze potential investment properties. Additionally, real estate auctions present an opportunity to uncover unique deals, potentially allowing you to secure properties at below-market values, enhancing the investment's profitability prospects. Thus, direct real estate investment offers a pathway to a controlled, resilient, and informed investment journey in the property market. Real estate investments, whether through REITs or direct ownership, offer compelling opportunities to protect your wealth from inflation. They provide potential income streams, diversification benefits, and a hedge against inflation. However, it's essential to conduct thorough research, understand the risks involved, and consider your financial objectives and risk tolerance. I'm excited for what's coming up next, and you should be too, because its potential is beyond expectations. Commodities. A commodity market is a market that trades in the primary economic sector rather than manufactured products, such as sugar, soybean, cocoa, gold, and oil. It's essentially about buying and selling raw materials like crops or metals to make a profit or protect against future price changes. Crude oil, gold, and base metal are the most commonly traded commodities in the world. By investing in commodities, you can diversify your investments and protect against risks like inflation. Why should you invest in commodities? Well, the first common reason is for the inflation hedge. Commodities often have an inverse relationship with the dollar. When inflation is high, the value of the dollar decreases, but commodities prices may increase. The second reason is to diversify your portfolio. Commodities have a low correlation with stocks and bonds, providing diversification benefits. Robert Kiyosaki, the famous writer of Rich Dad, Poor Dad, believe gold, silver firmly recommend to invest in commodities. He continually stresses gold and silver are the only money that have endured the destruction of economies, the fall of empires, and the end of historical time. So investing in commodities not only protect your asset against inflation, but also is the best way to diversify your portfolio. Gold has appreciated significantly over the past 50 years. From 97 per ounce in 1973 to approximately 1,965 per ounce in 2023, the price of gold has increased by about 20 times. There are 3 ways to invest in the commodities, and anyone can start as little as they can. The first way is by acquiring physical asset. An investor can acquire physical gold by purchasing it from reputable sources such as bullion dealers, banks, or official mints. Online bullion dealers offer a convenient way to buy gold coins or bars and have them securely shipped to your location. Local dealers and banks allow for direct purchase, providing an opportunity to physically inspect the gold before buying. What if you don't want to own physical gold for security purpose? Well, you can use one of this way to purchase your gold. Investing in commodities without physically owning them has become increasingly accessible, thanks to financial instruments like ETFs and futures contracts. Exchange-traded funds, ETFs, allow investors to buy shares of a fund that holds a variety of commodities, offering a diversified exposure. ETFs are traded on stock exchanges, making them easily accessible to a wide range of investors. On the other hand, futures contracts are agreements to buy or sell a specific amount of a commodity at a predetermined price in the future. This allows investors to speculate on price changes, potentially earning profits from market fluctuations. Futures contracts carry a higher level of risk due to market uncertainties and fluctuations. Investing in commodities and precious metals can be a strategic component of a well-diversified portfolio, offering protection against inflation and economic uncertainties. These tangible assets carry intrinsic values that often stand resilient against economic downturns. However, it's essential to conduct thorough research and consider the risks and costs associated with investing in these assets. Different investment vehicles, such as physical ownership, ETFs, and stocks, offer various ways to invest in commodities and precious metals, each with its own set of considerations and implications. Thank you for watching. Please don't forget to subscribe and turn the notification bell to stay updated with our content. Have a wonderful time. I will see you in the next video.